Do you ever feel like your 9 to 5 is locking you out of the stock market? Well, today we're going to break down a trading plan built specifically for busy people. It's a strategy that focuses all its energy into just 2 key hours of the day. All right, let's get into it.
So you've got your career, right? But you've also got that nagging feeling, that itch to get in the market and trade. The big question is, how do you even begin to keep up with it all when you're supposed to be working? That's the exact problem we're tackling head-on.
You know, funny enough, this whole complex strategy, it might just boil down to this single number. 2.
Yep, that's it. 2 hours. This whole approach is about being a sniper, not a machine gunner. It means forgetting about being glued to a screen all day long and instead laser focusing on 2 very specific windows of time. So, how's that even possible? Let's find out.
Okay, I want you to think about the stock market like it's a major highway. Most of the day, traffic is just kind of flowing. But then there's rush hour. And this strategy is all about learning to drive in that rush hour traffic because that's where all the action is. The first hour after the opening bell and the last hour before the close, they are a totally different animal compared to the rest of the trading day. This is when the floodgates burst open. A tidal wave of trading volume comes pouring in, and that creates these huge price swings, the kind of volatility that spells opportunity.
So why exactly is it so chaotic? Well, this slide breaks down you could call it organized madness. In the morning, you've got this massive pileup of orders that built up overnight. Plus, all the big institutional programs kick in, and day traders are jumping in to start their day. Then, in that final hour, it is a mad scramble for the exit. Day traders have to close out their positions, and big institutions are making their final massive moves. It is an incredible amount of action packed into just 60 minutes.
Now, to survive this market rush hour, you can't just go in blind. You need a specific tool, a secret weapon for maintaining discipline. It's called a limit order, and honestly, it is the key to staying in control when things get wild.
Here's the critical difference. A market order basically shouts, "Just get me in, I'll pay whatever the price is right now." A limit order, on the other hand, is you calmly saying, "I am only willing to buy at this price or sell at that price, and not 1 cent more or less." It puts you in charge.
Let's make this crystal clear. Picture this. You own shares of company XYZ. You've decided you're ready to sell, but you absolutely will not accept less than $34 a share. So you place a sell limit order right at $34.00. That is your line in the sand. If the stock price hits $34, or even better, climbs higher, boom, your order executes. But if it only gets to, say, $33.99, your order does nothing. It just sits there. You hold all the power.
But, and this is a really big but, that control has a price. There's a trade-off. If the stock price never reaches your limit, your order will never get filled. It'll just expire. You could literally watch a stock get close to your price and then take off in the other direction, leaving you on the sidelines. It's that constant tug of war between control and participation.
All right, so now that you have your tool, let's talk about a specific play you can run within this 2-hour window. It's a strategy that thrives on what happens when the market is closed. We're talking about gap trading.
So, what is a gap? It's basically a price jump or a price drop that happens overnight, between when the market closes and when it opens the next day. It literally looks like a blank space on the chart because no trading happened at those in-between prices. It's usually caused by some big news that breaks after hours. Let me walk you through a quick example. So imagine company ABC closes the day trading at $30 per share. And then, overnight, they release an incredible earnings report. The news is fantastic, so the next morning when the market opens, the stock doesn't start trading at $30. It gaps up, opening way up at $35. And that $5 jump right there, that's the gap. If you had bought the stock at the close for $30, you could potentially sell it the second the market opens at $35, capturing that profit from the overnight move. That's the essence of gap trading.
Okay, before you get too carried away with the idea of these quick in-and-out trades, we need to talk about a major roadblock. It's a regulatory rule that you absolutely have to know about. It's called the pattern day trader rule.
So what on earth is a pattern day trader? Well, it's a specific label that regulators can put on your account if you trade too frequently. And trust me, it's a label that comes with some pretty strict requirements.
The whole rule really comes down to 2 numbers. The first one you need to remember is 4.
And the second number is 5. So we have 4 And we have 5.
And here's how it all fits together. If you make 4 or more day trades, and a day trade is buying and then selling the same stock on the same day within a rolling 5 business day period, you get flagged as a pattern day trader. Now here's the kicker. Once you're flagged, you are legally required to keep a minimum of $25,000 in your account. If your balance drops below that, your day trading ability gets shut down.
So how do you trade on a short-term basis and legally sidestep this rule? The workaround is surprisingly simple. You buy a stock near the end of the day and you sell it the next morning. See, because you held it overnight, you never bought and sold it on the same day, so it doesn't count as a day trade. But I have to warn you, just because it's a legal workaround doesn't make it safe. This is still a very high-risk, speculative way to trade.
All right, we've laid out the entire plan. We've talked about the when, the how, and the what. But that leaves us with the most important question of all. Is this intense, high-speed, 2-hour strategy actually a good fit for you?
So let's run through the final checklist. 1. Focus on the market's rush hour. 2. Use limit orders like your life depends on it, because that's your control. 3. Hunt for those gap trading opportunities. 4. Be smart and avoid the PDT rule by holding overnight. But 5, and this is easily the most critical point on the entire list, you have got to be brutally honest with yourself about the insane volatility and the very real risk you're taking on.
Look, the market's rush hour happens every single day, with or without you. It's a chaotic, high-speed environment full of opportunity and risk. The only real question left is, are you prepared to get behind the wheel and navigate that traffic?